Hello everyone, welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of the book Beat the Market by Gerald Appel. It has been created with the help of AI. You can read the original summary at samfury.com.
All right, so today we're diving deep into Beat the Market by Gerald Appel.
Oh, yeah.
Familiar with this one?
Oh, absolutely love Appel's work.
Yeah, it's a classic.
It is a classic.
So much good stuff in here.
Yeah. Tons of actionable advice for investors.
And that's what we're going to try to unpack today.
Right.
See if we can distill some of these key strategies that he lays out and see what we can apply to our own investing journeys.
Absolutely.
And I think one of the things that struck me right off the bat reading this is that Appel really emphasizes the importance of psychology.
Oh, yeah, 100%.
Right? It's not just about picking the right stocks or timing the market perfectly.
Yeah.
It's about managing your own emotions and biases.
Yeah, he really hits hard on that, doesn't he?
He does. And I think that's something that a lot of kind of intro books or the surface level stuff doesn't really address.
It's easy to overlook, right?
It is. And he really dives deep into that, which I appreciate.
Yeah, because, I mean, fear and greed, those are the two big ones, right?
Absolutely.
Those can really sabotage your returns if you let them.
No question. So how does he suggest we go about building that solid foundation, that disciplined approach?
Well, he's all about data-driven decisions. He
Yeah.
really lays out a system that relies heavily on understanding market indicators
Okay.
and not just looking at one indicator in isolation,
Right.
but using multiple indicators together to get a more comprehensive view.
It's interesting. So it's about not putting all your eggs in one basket in terms of information either.
And about getting that kind of 360-degree view of the market.
So for someone who's maybe not super familiar with all these different indicators, what are some of the key ones that he talks about?
Well, one of the big ones he introduces is the bond stock valuation model.
Okay.
It sounds kind of complicated, but it's actually pretty straightforward.
All right. Break it down for us.
Basically, it involves comparing the yields on government bonds to the earnings yield of the stock market.
Okay. So we're not just looking at stocks in a vacuum. We're comparing them to other investment options like bonds.
Precisely. You want to see how stocks stack up against those safer assets.
And how does that comparison actually help us make decisions?
Well, think about it this way. If bond yields are relatively high,
Okay.
it suggests that investors are demanding a higher return for holding those safer assets, right?
Makes sense.
So if the earnings yield of the stock market is significantly higher than bond yields,
Okay.
it could be a sign that stocks are undervalued.
Oh, interesting. So we're looking for those relative bargains.
It's all about finding those opportunities where the potential return outweighs the perceived risk.
I like that. And he doesn't stop there, right?
Oh, no, he's got a whole bag of tricks.
What else does he throw into the mix?
Well, he introduces this concept he calls indicator synergy, where using multiple indicators together can give you even greater insight.
Oh, so the whole is greater than the sum of its parts kind of thing.
Yeah, that's a good way to put it.
So give us an example. What kind of indicators would we be looking at together?
Well, in addition to the bond stock valuation model, he talks about things like breadth indicators,
Okay.
which measure the participation of stocks in a market move.
So how many stocks are actually contributing to a rally or a decline?
Because the market might be going up,
Yeah.
but if only a handful of stocks are driving that increase, it could be a sign of underlying weakness.
So it's not just about whether the market as a whole is moving up or down.
Nope.
It's also about like the breadth of that movement.
Precisely. You want to see broad-based participation for a truly healthy market.
That makes a lot of sense. And how does that tie into this indicator synergy idea?
Well, Appel found that by combining these different indicators, particularly when they were all strongly positive,
Okay.
it actually led to remarkably accurate predictions of future market performance.
Wow. So he's crunched the numbers.
Oh, yeah, he's got the data to back it up. He claims his combined indicator approach
Okay.
resulted in a 92.59% profit ratio.
Wow. That's a pretty impressive track record.
It's pretty remarkable.
So what were some of the key combinations that led to those kinds of results?
Well, one example he gives is combining the bond stock valuation model with a breadth indicator and a measure of investor sentiment. So when all three of those were aligned positively,
Yeah.
it created a very strong signal to buy.
So those three things kind of converging to create this perfect storm
Yeah, you could say that.
of opportunity. So it's not just about following one simple rule. It's about understanding how these different forces interact.
That's the key. You got to see the bigger picture.
A bigger picture.
Yeah.
And that's where I think Appel's approach really shines.
I agree. He really does a great job of connecting the dots.
He does. And it's not about trying to time the market perfectly, right?
No one can do that consistently.
It's about identifying those periods where the odds are in your favor
That's the goal.
and then investing accordingly.
Smart investing is about playing the probabilities.
The probabilities. So even when you've identified these periods where things look good, he's still a big proponent of diversification, right?
Oh, absolutely. You never want to put all your eggs in one basket.
Now, diversification, that's a pretty common piece of advice in the investing world. Everyone talks about that.
It's investing 101.
But what's Appel's unique spin on it? How does he suggest investors actually approach building that diversified portfolio?
Well, he takes a multi-layered approach.
Okay.
It's not just about spreading your money across different asset classes like stocks and bonds.
Right.
He also advocates for diversification within those asset classes.
Interesting. So what would that look like in practice?
Sure. So, for example, when it comes to stocks,
Okay.
he recommends not just investing in a handful of individual companies, but instead using low-cost index funds or ETFs.
All right. So getting that broader exposure through those vehicles.
Because with an index fund or an ETF, you're essentially owning a basket of stocks,
Right.
which automatically spreads your risk.
Yeah, that makes sense. But I mean, there's thousands of index funds and ETFs out there, right?
Oh, there's no shortage of options, that's for sure.
So how do you even begin to choose?
Well, Appel highlights the importance of considering expense ratios when selecting funds.
Expense ratios. Oh, okay.
Because even those seemingly small differences in fees
Yeah.
can have a big impact on your returns over time.
So it's not just about picking funds that have done well in the past.
Yep.
It's also about looking at how much they're going to cost you to own.
You want to make sure those fees aren't eating into your profits.
Right. So what kind of expense ratios should investors be aiming for?
Well, he advises looking for funds with expense ratios below 0.5%,
Okay.
and ideally even lower.
All right.
He points out that some index funds and ETFs have expense ratios as low as 0.1% or even less. Oh, wow.
Which can make a huge difference in your long-term returns.
It's like death by 1,000 cuts, right? Those little fees can really add up.
They can sneak up on you if you're not careful.
Okay, so we've got our indicators, we're diversifying our portfolio, we're being mindful of those expense ratios.
Right.
What about this idea of momentum investing that Appel is known for?
So momentum investing is essentially about identifying assets that are already on an upward trajectory
Okay.
and then capitalizing on that trend.
It's catching a wave that's already building.
That's a great analogy.
Ride it as long as you can.
But Appel stresses that even with momentum investing, there's a crucial caveat. He emphasizes the importance of regular rebalancing. Even if a particular stock or sector is performing exceptionally well,
Yeah.
you shouldn't let it become too dominant in your portfolio. So it's about maintaining that balance, even when you're riding a winning streak.
That's right. You got to stay disciplined because market conditions can change quickly.
Right.
What's hot today might cool down tomorrow.
So you're basically taking some profits off the table from your winners
Exactly.
and reallocating them to other areas of your portfolio that may be lagging.
It's like pruning a garden. You want to trim back the branches that are getting too big.
To make sure everything's growing in a healthy way.
Precisely. And remember, Appel's approach is all about managing risk
Right.
while still aiming for those solid returns.
It's that balance. So we're not blindly chasing the hottest stocks.
Nope.
We're strategically allocating our assets,
Right.
rebalancing our portfolio, and always kind of staying aligned with our overall goals.
You got it.
It's a more holistic approach, isn't it?
It is. It's about looking at the big picture.
And he also talks a lot about the importance of starting early.
Time is your greatest ally when it comes to investing.
Let that compounding do its work.
Absolutely. Even small amounts invested consistently over time.
Can grow into something significant. But let's be real, even with a solid strategy in place, investing can be pretty intimidating.
Oh, it can be for sure.
There's always that fear of making a mistake,
Yeah.
losing money.
Yeah. Nobody likes to lose money.
How does Appel address that psychological challenge, that very real fear that people have?
Well, he dedicates a significant portion of his book to the psychological aspects of investing.
Really?
He argues that understanding and managing your emotions is just as crucial as understanding the financial markets themselves.
Oh, wow. So it's not just about the numbers. It's about having the mental fortitude to stick to your plan.
Even when the market is testing you.
When things get crazy, when you're seeing red all over the place.
That's when it's most important to stay disciplined.
To not panic and make those emotional decisions that you'll regret later.
He even offers specific techniques for recognizing and mitigating those emotional biases.
Oh, that's interesting. Can you give us an example? What's one practical step that listeners can take to manage their emotions?
Well, one thing he suggests is creating a written investment plan
Okay.
and then committing to it, even when things get turbulent. Having that plan in place can really help you stay focused on your long-term goals.
It helps you navigate through those inevitable ups and downs.
It's your North Star.
Yeah, and I think that's something that's so easy to lose sight of.
It is, especially when the market gets volatile.
You get caught up in the day-to-day noise.
It's all about tuning out that noise and sticking to your plan.
It's about being proactive, right, rather than reactive.
Taking control of your investment journey rather than letting your emotions control you.
Having that predetermined plan helps you avoid those knee-jerk reactions that can sometimes lead to regret later on.
Absolutely keeps you grounded.
Yeah, it keeps you grounded. But even with the best plan in place,
Right.
there are going to be times when the market takes a dip.
Oh, for sure.
It's going to happen.
It's part of the cycle.
So how does Appel suggest we navigate those inevitable downturns?
Well, he emphasizes that market downturns are a natural part of the investment cycle.
Okay.
They're not something to be feared, but rather an opportunity to potentially buy more of your favorite assets at a discount.
The classic buy low, sell high philosophy.
Yeah.
But how do we know when we're actually at a low point?
Right. You don't want to catch a falling knife. That's where those indicators we discussed earlier become really valuable.
Okay.
For example, if the bond stock valuation model is showing that stocks are significantly undervalued compared to bonds, and breadth indicators are confirming that the market is oversold, it could be a signal that a bottom is near.
So we're looking for that confluence of signal, confirmation from multiple sources. And then on the psychology side, how do we manage those emotions that often creep in
Oh, yeah.
during a downturn? That fear, the uncertainty.
Yeah. Well, Appel suggests focusing on the long term.
Okay.
Reminding yourself that market fluctuations are normal. Don't get caught up in the day-to-day noise.
But how do we know when it's time to sell? Is there a set of indicators that signal when it's time to take profits or maybe get out of a particular investment?
He provides some guidance on that as well.
Right.
For instance, if the bond stock valuation model starts to show that stocks are overvalued compared to bonds, or if breadth indicators suggest that a market rally is losing steam,
Okay.
it could be a sign that it's time to trim some of your holdings.
So we're basically using the same indicators that we use to identify those buying opportunities, but now we're looking for those signals to reverse.
Right, you got to be adaptable.
Yeah.
Adjust your strategy as the market changes.
It's about recognizing when the tide is turning.
That's a good way to put it.
But with all this talk of indicators and market timing,
Yeah.
it's important to remember that Appel's approach is not about trying to time the market perfectly, right?
That's right. Even the best indicators aren't foolproof.
Right.
There will be times when the market surprises you,
It always does.
both to the upside and the downside.
So it's not about predicting the future with absolute certainty.
Right.
It's about having a system that tilts the odds in your favor over the long run.
It's a probability game.
And that system includes not only understanding the technical aspects,
Right.
but also managing your own psychology. It's all connected, right?
You can have the best strategy in the world,
Yeah,
but if you can't control your emotions,
right.
you're going to sabotage yourself.
You're going to make those impulsive decisions that are going to cost you in the long run.
Discipline is key.
So for those who are maybe just starting their investment journey,
Yeah.
what are some of the key takeaways from Appel's book that they should keep in mind?
Well, I'd say the most important takeaway is that investing doesn't have to be overly complicated.
Okay.
Following a few simple principles,
Okay.
like understanding market trends, using indicators to guide your decisions,
Hmm.
diversifying your portfolio, and managing your emotions,
Yeah.
you can significantly increase your chances of success.
So it's about having that solid framework in place, that
Yeah.
set of guiding principles that can help you navigate the complexities of the market.
You don't need to be a financial expert. Keep it simple.
But wouldn't you say that continuous learning is also a crucial part of this?
Absolutely. The market is constantly evolving.
It is.
New challenges and opportunities are always emerging.
So it's like any skill or craft,
Yeah.
you never truly stop learning and refining your approach.
You got to stay ahead of the curve. And that brings us to another important point.
What's that?
Finding reliable sources of information, because there's so much financial noise out there. So how do you suggest investors cut through the clutter and find those insights that truly matter?
Well, Appel emphasizes the importance of seeking out credible, unbiased sources of information.
Okay.
Focus on publications and experts who have a proven track record of accuracy and integrity.
So do your due diligence, vet your sources?
Don't believe everything you read online.
Right. And what about the role of financial advisors?
Yeah.
Is there a place for them in Appel's approach?
While Appel's book provides a comprehensive framework for self-directed investing,
Okay.
he acknowledges that many investors may benefit from seeking professional guidance, particularly those who may not have the time or the inclination to manage their own investments.
So it's not an either-or proposition. It's about finding the approach that works best.
For your individual circumstances and your comfort level, and for those who do choose to go this self-directed route,
Yeah.
what are some of the key resources or tools that Appel recommends?
Well, he suggests utilizing financial websites and software programs that provide access to market data research reports and portfolio tracking tools.
So leverage technology to streamline your research and analysis.
Make things easier for yourself.
And what about the role of community and peer learning?
No, that's a good one.
Does Appel address that at all in his book?
He doesn't specifically delve into that,
Okay.
but I think it's an important consideration. Connecting with other investors,
Yeah.
sharing ideas, learning from each other's experiences.
Tapping into that collective wisdom of the crowd, right?
Iron sharpens iron.
So we've covered a lot of ground here, from market indicators and diversification
Right.
to managing emotions and navigating downturns. Before we wrap up, is there any final piece of advice that stands out to you?
I think the most important thing to remember is that investing is a marathon, not a sprint. It's about making consistent, informed decisions over time, not chasing quick wins or trying to time the market perfectly.
Right. It's about playing the long game, understanding that wealth building is a gradual process
It takes time.
that requires patience, discipline, and a willingness to learn and adapt along the way.
You got it.
And for those who are feeling maybe overwhelmed or intimidated by the prospect of investing,
Yeah.
what would you say to encourage them to take that first step?
I'd say that investing is not just for the wealthy or the financially savvy.
Okay.
It's accessible to anyone who's willing to put in the time and effort to learn the basics and develop a sound strategy.
It's about empowering yourself. Take control of your financial future.
And the rewards can be life-changing.
They can be.
Yeah.
They can be. It's about building that more secure and prosperous life for yourself and for your loved ones.
Absolutely. Financial freedom is within reach.
And with that powerful message, I think we'll wrap up this deep dive into Beat the Market.
Happy investing.
And until next time, keep diving deep.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.